Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today, we welcome Melody Wright. She is a housing analyst and author of a great Substack on the housing market. Melody, thank you for joining us.
Thank you so much for having me. It's my pleasure.
Melody, let's start with the latest on the housing market. We had new home sales data come in quite weak, but give us your overall sense of what's happening in housing today.
Well, what I've been saying recently, just to keep people from going a little insane because the data seems to be all over the place, is 'tis the season. This is the season for the housing market. And what does that mean? That means that even during the GFC, you had home prices rise during the season. And this I remember very well being very confusing to my executives. They always wanted to see it as, oh, yay, everything is turning around. It's all going to be great from here. But and honestly, that's what every economist from within the industry was saying. That was what mainstream media was also saying. But in reality, that was a lot of false flags. And there just weren't people that truly came with a knowledge of the housing industry. And so we're in the season right now. We're in the high season for housing. And so you're going to see a lot of activity. What we've just recently seen that I think surprised a lot of people was, in the existing home market, we reached an all-time high for existing homes. But what's important to understand about that is, number one, it's the season. But number two, who is transacting in the market right now? And if you kind of dive into the guts of the National Association of Realtors, or NAR report, you're going to see that the biggest increases we've seen year over year are in that 1 million plus home category. And before everybody says, hey, well, that's because of inflation, everybody can afford it. I think most of us realize that study this stuff, that wages are not rising at the same pace. And so we cannot afford it. And so what I'm beginning to believe is that median is going to give some false flags here as we're turning the inflection point. And that's the existing home market, which, had some negative sales year over year, but month over month was still quite positive. I look at non-seasonally adjusted. So what I'm saying may sound very different from what you hear, but what I have come to understand about seasonal adjustments is, thank you very much, I can look year over year and I can think to myself, we had one more holiday or something like that. But what happens is, I think what happens with any data that you model and you continue to do little shortcuts here, there, and everywhere, suddenly you don't really have any understanding of what's happening on the ground. And a lot of times what you're reading about in the news is not what actually happened, but how they're needing to adjust the model to get that not seasonal, but that annualized number, because they start the year off thinking it's going to be very strong. Typically, there's usually a positive bias, and then they're adjusting it. And so then you think, oh, sales were down month over month. In reality, they were fairly, strong in the existing market. And the new home market, though, that was a complete whoa. Sales were revised up last month, but that does not matter. Year over year, May last year, much higher. And there we saw something crazy happen, which is new home prices actually, so they were revised down last month. Even still, we had a further revision down this month. And so now new home prices are actually lower than existing home prices. And this has only happened 2 other times in a 25-year history. And that was in June of 2006 and June of 21, both of which were very bubblicious times in the housing market. And that is your peak for the existing market. And so there's a lot of noise out there, a lot going on. But honestly, we could see prices go even a bit higher, because June is when those existing home prices typically peak. But I said a lot, so I'll stop there and see if you have any questions.
The Bitcoin Layer is sponsored by River. River is a Bitcoin-only exchange if you guys are looking for a place to get allocated. Go check them out today at river.com/TBL for a special offer of up to $100 in Bitcoin for free when you purchase. The most important thing about River is that River does not use a third-party custodian for Bitcoin. That means when you purchase Bitcoin on River, River has its own storage solution and is not relying on any third party to custody that Bitcoin. It also means that they have an amazing technical expertise. It's a great team over there at River. Go check them out, river.com/TBL. There's a lot to dissect with the data, and one of the reasons we wanted to have you on, and I was excited about this interview, is because as economic watchers, we get our new home sales, our existing home sales. We get trailing Case-Shiller, which you've talked about the downsides to Case-Shiller. I've recently, come to understand that. Now we have Redfin and Zillow, which I'm starting to watch heavily. There's NAR, which you're quoting as well, which actually Jerome Powell quoted NAR in, I can't remember if it was his latest or the previous press conference, where he's talking about spot rents coming down. So let me just ask you then, what is the highest signal form of data that you go to? And maybe you can break it down between prices and sales, or even inventories, or however you want to classify it. What should we be watching first and then second? And where should we be watching it from? Is it prices? Is it sales? And what are the sources that are most indicative to you?
Yeah, and if there was an easy answer to that, I wouldn't be here right now, but I want to give people tools. There are so many different data series out there. They're all constructed differently. They all as well have some vested interest. And so but there are places that are better than others. But what I'll say to everybody before I even give you those tools is that you need to go look for yourself. You need to, if you think you want to live somewhere, you need to go there and you need to drive around, and not just to the place that you think you want to live. You need to go to the outer neighborhoods. You need to drive that whole city, north, south, the entire perimeter. You need to talk to people there. This is the only way you're truly going to understand a neighborhood and a housing market. Because the one thing I've seen with all my boots on the ground travel all over the country is that there's a ton of hidden vacancy, as well as there are a ton of for sale signs that you're not going to find on any listing site. And I think, unfortunately, with COVID, we all got a little too comfortable of not really going out and looking for ourselves. And we were relying on these cool new internet tools. But with something like Zillow, for instance, their default filter when you search on that application is for coming soon homes. Those aren't even homes that are available. Those are ones that are secretly being marketed on the back end to a realtor's contacts. And so when you are like, oh, it's finally available, and you type and you call and you do whatever, they're going to tell you, oh, sorry, we had multiple offers, blah, blah, blah. What they're doing is creating FOMO. In reality, that's been marketed for some time. And so that's the entire system is set up that way. But I'll give you kind of like which places I go to, because I triangulate, meaning I'm looking at all of them, and no human can really look at all of them, even with the help of AI or assistants. But I'm really trying to build out a model that has as many of these inputs so that you can triangulate and get a true understanding of what's happening. But I'll say from an inventory perspective, I would look at two sources. That would be realtor.com. They have the most connection right this very second, and I'll talk about that in a minute, to the MLSs, are multiple listing sites. And these are these big databases that are in every local region. There's over 600 in the country, but they have the most access. And so they're going to have way more listings than Redfin and Zillow. Even the private sources out there that claim they have every single listing, that's categorically untrue, and ask them how. They will not be able to tell you. So I would look at Realtor as well as New Home Source, which is another website. And that's specifically for new homes, but that map is going to tell you when you type in your city, a map's going to come up of all the new home communities. You're going to be able to tell, okay, Where's the speculation? What's going on? Where do I need to avoid? Because what I found in places like Round Rock, Texas, for instance, you could drive 1 mile, take and see 6 new build sites, take a right and see 6 more. But most people didn't take that right, so they don't know that there's all those other sites. So those are 2 sources from an inventory perspective. When it comes to prices, they're just, there is no good source, but what you can do is just look at a variety of them and take it with a grain of salt and look for directional versus absolute. Meaning, okay, are they kind of moving in an upward direction, downward direction? I wouldn't look at that absolute number. Because right now we're in a frozen market, meaning sellers still believe they're getting, going to get some crazy prices. And when you do a deep dive, I was helping a friend out looking in Plano, Texas, and everybody was pricing about 30 to 50,000 over the market value you could find at the county when the county appraisals office did it, for instance. And so what I would say there is you need to do some more sleuthing about prices. You can go to county records. In a lot of states, you can see exactly what was paid the last time. You can also see what I was just talking about, the appraisal. So I would use those county resources. And that's kind of hard, and I get it. But if you're truly trying to get a good deal out there, and you don't want to read my Substack, for instance, I track 82 cities. So I'm doing a lot of that work for you. But that's what I would recommend. And then from an overall market perspective, we are just living on narrative right now. And I think that just validate your assumptions. Just because you read it, it's not true. And then find those people and voices that you trust on certain subjects, like, and test them out, like, who do I trust to talk to me about rates? That takes some time, but you do have to find those trusted sources. So it's a real challenge. I mean, it's hard for folks. So
why are the for sale signs that you see not online? Can you explain that to us?
Yeah. So this is something, as somebody coming from within the industry, this wasn't something I really understood. And then when I talked to realtors, they were like, this doesn't exist. But then I was in a conference out in Vegas last year, and I met some brokers and started hearing about private note sales. And then I had more followers contact me. And then you would see stories in the Wall Street Journal and Bloomberg about private note sales. And then Inman, which is a big industry publication, did a series last summer about pocket listings, or listings that never make it to the MLS. And they did a study in Austin. And what they realized was that in 3 neighborhoods in Austin, over 50% of the sales were pocket listings that never made it to the MLS. Now, this is typically more for your upper scale home buyers, but also there's a portion of this private note market. Just think about the we buy houses, we buy ugly houses, right? You see those signs out there. And so what I've come to understand after a recent trip to Nashville and a private note conference there, this is much bigger than anyone is thinking or comprehending. And it can take different forms. One is seller financing, something I've been told we saw a lot of in the 80s. This is where I say, I want to sell you my house, but maybe you don't like the rates at the bank. I know your money good. We're going to come up with a contract. You're going to take care of all of the, maintenance, blah, blah, blah. But you're just going to pay me month. Well, 28 billion we know was done in this industry last year. But I think that's actually the number's higher, because I think that's what they could track in the MLS. I think a lot of this is happening out of the MLS. Then you have these things called sub twos, or where subject to, where there's this whole group of people. One of the Facebook groups has 13,000 people that are going out and they're actually contacting. They see that you filed a note, that not you, but your bank has filed a notice of default at the county or and there's whole programs that will give them your name and phone number. And if for a small $10, $20 a month, and they're going to call you and they're going to say, hey, I know you can't pay your mortgage right now. I'll take it over. I've got an investor interested in your house. Do you want to stay? Do you want to go? What do you want to do? And they'll come up with an arrangement that maybe they're going to get an investor, pay off the loan. They'll be paying your mortgage, but you're still on the note. Even if they record the deed, you are still on the note. The deed does not show transfer of title, unlike, well, even with an auto, you have to, if you still have that note, that promissory note, that is what will give you standing to take possession. So what happens is these guys pay the mortgage, but the borrower, if the loan hasn't been paid off, they're the one on the hooks. And then there's a third subset of this, which were all of the agencies, the GSE, Fannie Mae, Freddie Mac, FHA, they do this thing called single family loan sales, where after 2015, they started just selling these off into the marketplace. This was after Wall Street had bought up all the foreclosures. Fannie, Freddie, they all realized, hey, we can transfer some of this risk out to the private marketplace. Not a lot of people know about these. Well, what these hedge funds, sometimes nonprofits, but a lot of times hedge funds, other types of funds would buy these properties, but then there'd be 50 or so that they're like, that's not really my wheelhouse. I know somebody who's better at dealing with this type of thing. And then they'd sell it off to a private individual. And so this market, I believe, is far bigger than what we think. And so it's giving us, we're having a false sense of delinquency and consumer stress when looking at the housing market, I would say.
So we have a false sense of delinquency. So that means that delinquencies that we're getting per the data are understated because there's all this shadow delinquency going on. And I want to ask you a follow-up as well about because you just explained to us why we're not seeing a lot of the title transfer hitting the market, right? So you mentioned Texas. Let's just go to Texas now. You've talked recently about shadow inventory there. You've been on the ground. You've seen what's going on. So what are we to expect in Texas, in Dallas, Austin, in these real estate markets that you've identified as having really a ton of shadow inventory?
Yeah, I think so we're already starting to see them get a little disorderly, definitely in Florida, and in, Austin has been hard hit from the beginning, but you're starting to see more and more inventory coming to the official market. You're also seeing price declines. So I believe, we're exiting the high season, but what I believe is we'll continue to grow inventory in these places or maintain it. But by the next season, 2025, we will definitely see more inventory. And I believe a lot more disorder as motivated selling will start to increase from here. And once we get there, then all bets are off.
Can you talk about Airbnb and the short-term rental world? Is that having an effect on residential broadly, or is it just a small portion and doesn't really factor in?
Yeah, so a lot of people say, okay, well, we know that real estate is local, and we know there was a lot of speculation in places like Phoenix and Austin, but in reality, wherever there was land infill and people were close, you will find these pockets. I'm in a very small town in Johnson City, Tennessee, which is an hour west of Asheville. And it is rampant with these short-term rentals. You go down the road to Sevierville, Tennessee, which is a county that has, Dollywood, things like that. It is a vacation hotspot, but it's not huge. There are over 8,000 short-term rentals. In Austin, Texas, there are over 15,000 short-term rentals. And so, unfortunately, you would like to say that, and there will be some places that are immune, but honestly, you can find this all over the country. Everyone decided to go buy a house and flip it and become a, Airbnb, and earn that passive income. And, it's hard for me to understand how prevalent it is. But as I talk to millennials, around the country that, there is so much second home ownership actually in that group, from just having access to cash, having access to get financing, and thinking that this truly was the golden goose ticket. So I believe, I mean, it's one of the reasons we think that there's a housing shortage. Like in Austin, you do not need 15,000 short-term rentals. You have plenty of hotels. So, this is a phenomenon that is going to reverse because they're not cash flowing, and it will definitely impact those markets as these properties come onto the market. And you're definitely seeing that already in Florida and Texas both.
So it sounds like there's so much overhang here. What is the big picture for housing? Are we in for a 3-year, massive bear market in residential real estate? Is it going to be less price based, or maybe just more time to churn? What is the big picture here for us?
Yeah. So, what I try to look at is the path. And, right now, what I'm asking everyone that I can find is tell me, what you see in our future, which would create these productive jobs in the face of AI that could give us an income that could sustain the home prices we're in right now. And everybody that the housing bulls, their only answer to this is that it's always worked out. And a lot of people look back at the 80s and, we had women joining the workforce. That's why that worked out. So we had additional income. Right now, you've got people all across America working 2 and 3 jobs because they're just trying to sustain their lifestyle. And we're seeing homelessness, increase. And so although I don't like talking about forecasts, I will give you what I see, unless there's an exogenous event. If we declare war, who knows, right? Everything changes. But I would say from probably August, I think we're going to start to see a real downward momentum in the housing market. And I think we might end the year at a 5% price decline, which won't be seen in some series like Case-Shiller for, another year. So, but I think it's 2025 where we're going to see the biggest price declines, because that's when all of these themes are just going to be hitting at the same time. Boomers wanting to get rid of their second homes because of property taxes and insurance. People, if we continue this trajectory, people are losing their jobs. We're seeing layoffs increase. And we're also seeing distress in multifamily, as you alluded to previously. That's impacting the super prime. The doctors, the lawyers, a lot of them are the owners of these short-term rental, and they're going to be looking for cash elsewhere as they're getting capital calls, or simply their money has disappeared. And so, I just think all of those, and plus we can get through the election and this micromanaged narrative that we're under right now, because I think that, there's a vested interest in people not understanding how weak the economy is, how weak the jobs market is. And so I think in 25, we are going to see some, probably around 12% price declines, and then a couple more years of correction. But again, we might become crazily creative, figure out some boom to humankind, and figure this all out by then. But that is the path that I feel that we're on right now.
Do you think Jerome Powell understands at least some of what you're talking about, making him more biased to explain, at least guide the markets that he will be cutting rates?
If he doesn't understand, that would very much concern me. I mean, he's been in private equity. He knows how these games work. I can't imagine that he can't at least understand some of this, which is why they've talked about housing. But the housing market is very large, and it's like the Titanic. It takes a very long time to turn. It sinks much faster. And so we are in the turning phase. And I think that's probably too, I have no idea what the man thinks, but I'm sure that's been a little frustrating as well. But the stock market mania, I think, has driven a lot, as well as the heroics that we saw after the banking crisis. I think that told it that everybody got a little pat on their head and said, it's all going to be okay. There's no recession. They'll be here if we need them. And let's just go forth and speculate. And I think that is kind of what we're experiencing right now. So I certainly hope he understands it.
And my question really stems from his quoting of NAR rents and watching that. So it would make sense to me that at least he's aware of this overhang, but he might not need to do all the deep dive into housing because he has other fish to fry. Melody, I want to ask you next about inventories, and as inventories build, when does it create the wave of price drops and the panic, and then getting the realized inventory? Because what you're suggesting is that there's a lot of shadow inventory. And so when does that all get realized, and is it a problem that is self-fulfilling?
Yeah, well, I think it's going to happen at different points in different markets. I think Florida and Texas are waking the rest of the country up. And I think this happens in every housing cycle. You have a handful of states that really drive the markets. You got a holdout in California right now, but I'm seeing some really interesting stuff month over month and year over year in terms of, sales and price reductions. But with your two very large markets, this changed the game. I mean, until what we saw in Florida, everybody thought I was an absolute crazy person, but I was down there last year for 2 months. I saw this and could see that we could see the inventory start growing, because Florida has an early season. It starts more like October and goes October for the snowbirds. We could see the inventory coming. And so I think the timing will be different for each market. But by this season next year, I think that shadow inventory has to come, because there's no place for it to hide anymore. And I think too, counties are going to start to come under stress, because these all cash sales that we know were not cash, they were leveraged elsewhere, either on crypto assets, all kinds of things. Previously, during the former crisis, your banks had to take care of those properties, cut the grass, take care of code violations, do all the work. If it was an all cash sale of an investor, that then becomes the county's problem. And so I think, we're going to start to see counties get involved in managing this vacant inventory, but that could also take quite some time as well. This is just so slow moving. And when we don't leave our houses anymore, or we don't, venture out and drive, then it's hard to answer that question, because in reality, the best way to see it is to go and look for yourself. And honestly, the drone footage that we capture looks the same, because it is, but it's all over the country. And so people just don't get it at scale. So I wish I could answer that, but likely it's when we officially get the word on recession. It's likely, when the administration, whoever that may be after the election, knows that in order to get the work done they need to do, they're going to have to call a recession.
And the reason they have to call a recession is because they have to get the ammo to fire the bazooka, as it's been known to be, called all over the world. In China, when they have problems, the fiscal bazooka. And during COVID, we had the same thing here in the United States with the unemployment benefits and all the PPP, and the fiscal stimulus that went along there. Melody, I want to shift gears for a little bit and talk about Fannie Mae and Freddie Mac. There's a program that's being discussed on Freddie financed home equity loans. So can you give us an update there and give us a sense of how this is going to impact the market?
Yeah, so last Friday it was conditionally approved. The FHA announced it. This was something that many of us in the industry was like a real body blow. I have to be honest. It just, for those of us that worked during the crisis, and I mean, I spent years talking to investors about how I was running off my second liens. I mean, we had sold them the majority of ours out at 10 cents on the dollar around 2010. And then I had firsthand witnessed when I managed to default just the destruction of, this debt, those second liens, home equities had done to prime borrowers. And I mean, it's devastating. And it was a bad word in the industry until very recently. And so what's been approved is, and why this is important, is that most of your lending happens outside of the banking system, believe it or not. It happens with the non-banks, and it's backed by the government. 85% of the mortgage market is government backed. You may or may not know it because their name is not going to show up, but they are the owners of those loans. And so by Freddie getting involved, it's like bringing juice to the system because the non-banks don't have deposits. So they can't, just kind of turn around and say, hey, I can use my deposits to help facilitate this, fund this. So all that the non-banks have are their liquidity facilities, which with your treasury background, the game there is all about the rates, just getting a little bit of that juice. And their game is a very thin margin game. And so they cannot play in this second lane space. And so with this Freddie program, they will be able to play. Freddie will purchase those from them and deliver them into the secondary market. Now, the program is capped at 2.5 billion. I don't think that it's going to be as big as some people like Meredith Whitney were talking about. And it's going to be focused on season loans or loans that were originated 2 years ago. And it's going to be time bound. So I don't think it's going to be crazy until, of course, they open it up a little bit, which will probably happen. But for the foreseeable future, it will have a slowing impact on what I see, but I think a lot of people that really need it, because a lot of your delinquency is actually in the 21 and 22 vintages, our origination year. I think the people that need it the most probably won't be able to qualify for it.
Melody, my last question to you is about your audience. And we are global macro analysts, so we're looking for indications on what the Fed might do. So we're looking to the housing market for information on the economy as one of the main, 20 to 25% of the US GDP is housing and housing related activity. So that's why we watch housing. But when you're answering my questions today, it's like you're speaking to the home buyer. So I want to know more about when you answer questions or when you write, is your audience the people that are homeowners and home buyers and are thinking about their portfolio? Is it the investment community? Is it a combination? And how has maybe your audience's diversity affected your research?
Yeah, so that is a really great question that no one else has answered. And it is a combination. And it is one of the reasons I probably feel like I'm in 80,000 places at once, because I feel like I really am trying to talk to the individual home buyer and seller, talk to your mom and pop investor, talk to your institutional investors, our bigger investors, in the hundreds, 200s. And so, because in reality, what I say, I don't mind if people invest in housing or can actually do a private note to help maybe modify a troubled borrower, things like that. But the problem is when people make housing a casino and are looking to, make something off of every minuscule home price move, and all sort of everything goes out the window of what home ownership is supposed to be about. And so I'm just trying to offer my perspective. And honestly, where I see kind of like in the middle are the mom and pop short-term rental investors or long-term rental investors who maybe had one property or two property, and they thought that was going to be their retirement. I mean, I think I probably talk to them the most. But my empathy, I feel like, is really with the home buyers, the generations of people that cannot qualify for home ownership right now. But I don't believe, of course, government interventions help. It hasn't helped at all. We've had government in the housing market since the 30s. So that's not the answer. But, good question. And some days I'm not exactly sure myself and where exactly I should be spending the most time.
Well, in my experience, writing what drives you in your research is the best path, and then people will find you. So we appreciate your work in housing. Keep being yourself, and we'll definitely keep reading. So please, Melody Wright, thank you for joining us. Please tell people where they can read your fantastic research on housing.
Oh, thank you for all of those amazing words, kind. So you can find my Substack, M3 Melody Substack. I'm also on X Twitter at M3_Melody. And then on YouTube, where, for folks that don't like to read, maybe I talk through what I'm writing about.
Great. Melody Wright, thank you so much for joining us today, and we'll catch you guys next time here at The Bitcoin Layer. The Bitcoin Layer is proud to be sponsored by River. River is a Bitcoin-only exchange, and we think it is the best place for you guys to get allocated if you have made that decision to purchase Bitcoin. So go check them out at river.com/TBL for a special offer of up to $100 in Bitcoin for free when you purchase.